Very much welcome to GAC Presents How to Invest in Stock Market Part 1. Hello friends, very much welcome to today's episode of How to Invest in Stock Markets from GAC. Up till now, we learned how and why a company is formed, how its stock trade in the market, both from the company's and investors' perspective. Thereafter, we learned about the market players, right from SEBI till company and investors. Thereafter, we learned about various indices, Sensex, Nifty, and we also learned about the sectoral indices. In today's episode, we are going to see the difference between trading and investing, as you can also make out from the board. By trading, in this episode, I mean day trading, which is also commonly called jobbing and scalping. Thereafter, we will also see two approaches, top-down approach and bottom-up approach of equity analysis, and thereafter we will see DuPont Analysis. Friends, we often have heard that stock market investment is very much like gambling. This myth is prevailing in the market because of day trading and scalping. Day trading is a process where traders buy and sell stock of a particular company the same very day, or in context of shorting, sell and buy stock of a particular company in the same very day. Scalping is even more short term. In scalping, scalpers try to benefit out of the momentum building in a particular stock, whether it's upside or downside. They buy and sell, or in case of shorting, sell and buy a particular stock within fraction of a minute, within few seconds. Friends, let me tell you, if you really want to make money from stock market, you can never succeed doing either day trading or scalping. This is a zero-sum game. If you want to take a few names of stock market mavens who have actually made money from stock market, like Rakesh Jhunjhunwala, Jolly Khanna, R.K. Damani, Vijay Kedia, we will see that none of them are traders. They all are investors. Even in our example, in the very first episode of GAC Promoter, where he wanted to take the company to the stock market to raise money for new upcoming project, which needed an investment of 50,000. What did the investor suspect? Until some outcome comes of that investment or project investment, how can investors think of any benefit or any losses through that project? Until a cycle completes of that company, meaning thereby. So if you have to invest, then you must invest at least for a cycle to complete for a company. That means at least 2 to 3 years to see the company's performance and all that. Then only you can expect to gain some benefit from the stock market investment. Friends, I'm not saying that no one can make money out of day trading and scalping. This is actually done and this is profitable as well. But this is never advisable to a retail investor because this needs a lot of resources. A group of financial engineers sit and thereafter they make various kind of algos and all that, and through algorithms these kind of trading, scalping or day trading happens. Then only it becomes profitable, and that too need to keep changing. If our audience, for the sake of knowledge, want to have a session on algorithmic trading, day trading and scalping, we can have a session on that, but that's never advisable for a retail investor. A retail investor, it's in interest of a retail investor to always be an investor and not a day trader. Now friends, coming back to our primary subject of inquiry, that is equity analysis. There are two approaches for equity analysis. One is top-down approach, another is bottom-up approach. In top-down approach, we try to study entire global trends and thereafter try to find out which are the markets or geographies or economies which can give us desired returns given our risk profile or risk preferences. Thereafter, we try to learn macroeconomic trends in those geographies, in those markets. Thereafter, which are the sectors which are going to be profitable, and thereafter which are the industries in those sectors which are going to be further even more profitable. And thereafter we try to scan through all the companies, that which are the companies which are performing good or have potential to perform good, and thereafter we try to see strengths, weaknesses, opportunities and threats of that company thriving in that particular sector. And thereafter we make investment decision. The bottom-up approach is very much opposite to the top-down approach. We get to know about a company, thereafter we study the company, whether its financials are good, whether it follows all the rules and regulations of corporate governance. Thereafter we see its strengths, weaknesses, opportunities and threats. Thereafter we see which industry it is operating in. Does that industry have any scope of progress, of development? Thereafter we try to analyze about the sector that industry working in, and thereafter macroeconomic trends of that particular area or geography, and thereafter we also try to analyze global trends, whether entire global economy is going to go up or down, and what effect it is going to have in that particular geography, and thus on that particular company, and thus we make the investment decision. Friends, it is always advisable to a retail investor to go for bottom-up approach, because top-down approach needs team of economists and analysts, and this is not a one-man job. Usually a retail investor is a lone guy, and that's why it's always advisable for him or her to follow the bottom-up approach. Even the company I am working with currently, they follow the same, or more often follow the bottom approach rather than top-down approach. It is actually the mix of approaches. We also study the industry and sector. If we like those, then we try to find out companies who are going to outperform the market. We also get to know about the companies, we get leads and all that on companies, and thereafter try to see whether those companies are going to outperform the market or not. Also, most of the investing houses I know are doing the same very thing. They follow the bottom-up approach. They get to know about a company and thereafter analyze that company, and thereafter make their investment decision whether to include that company in their portfolio or not. Now friends, I am going to share my experience of analyzing equities. I usually start analyzing an equity with DuPont Analysis. What primarily an investor is interested in? Investor is interested in investment in a company which actually is able to generate sustainable profits. Profits given our equity. Basically, we are interested in return on equity. That is our net income upon equity. Net income divided by equity. This net income is income arrived after paying all the payables, whether it is taxes, whether it is interest, or whatever payables are due to the company. That is divided by the actual investment, the equity. That's our return on equity that an investor is interested in. We try to break this expression of return on equity further down to get some more valuable information about the operations of a company. We actually divide this expression by revenue and again multiply the expression with revenue, thus not changing the original expression. We do that again, divide the expression by assets and multiply the expression by assets. And finally, we have got our net income upon equity. Thus, what we do that we have broken our return on equity into three different expressions. That's net income upon revenue into revenue upon assets into assets upon equity. Thus, we get to know actually the source of return on equity, from where this return on equity is actually coming, whether it is coming from net income upon revenue, that's net income upon margin, revenue upon assets, that's our asset turnover, or the leverage, that's assets upon equity. If we are getting this return on equity from our net income margin, this tells us that we are able to generate that much net income out of this revenue. If we are able to get this return from revenue upon assets, that tells that company is operationally very much proficient. It is able to generate more revenue given the assets. If we are using leverage to get this return on equity, then that means that company has taken a lot of debt as against this equity, which is not a good sign for any company, which no investor or no company wants. This will become more clear when we learn furthermore about leverage. That is, we are going to do now. Friends, we'll try to learn a little more about leverage. Why leverage is not good as a source of return on equity for a company. I have written the DuPont equation in short here as well. Net income upon revenue, revenue upon assets, assets upon equity. Okay. If we try to recall the very first episode of GAC, where the promoter wanted to take the company to the share market, the entire assets at the third year of the company, the entire assets of the company was 30,000. The equity of the company was 8,000, which was also the initial equity of the company, and liabilities of the company were 22,000. An asset of a company equals its liabilities plus its equity. So coming back to the expression leverage, which is equals to assets upon equity, it actually becomes equity plus liabilities upon equity. Equity is already there in the denominator, it's already there in the nominator. So if leverage increases, that means our liability is increasing. So no company, no investor wants his or her company's leverage to increase as a source of its return on equity. Friends, I find this DuPont analysis extremely useful in analyzing a company. It actually tells me that which are the indicators of the company which are up should actually be less, which indicators of the company which should be less are actually up. In sum total, it tells me the source of return on equity of a company. This expression can further be broken down to find out various other sources and elements of return on equity. For that, you need to be very much familiar with the components of financial statements like profit and loss, balance sheet, etc. etc. In our next episode, we are going to learn about those financial statements and their components. Till then, thank you very much. So friends, if you like today's session, do subscribe to our channel, like and share its videos. This will motivate us keep creating such videos and disseminate quality education and information. Once again, thank you very much.